Good afternoon, everyone. David speaking. I'm recording this on Tuesday, the 9th of November, and you should get it in your inbox on Saturday, the 13th. In the essay, I wrote about how to define a trend, and I wrote about Charles Dow's 3 measures of a trend. Quite difficult to explain in words, so I thought I would just do a short video with some sketches to fully explain Charles Dow's 3 types of trends. First of all, markets rarely go up in a straight line, apart from, of course, last week when the American market just streaked up. But most of the time, they'll rise in a series of rising lows, and the Americans refer to this as peak and trough progression. So chartists sometimes draw a trend line under these. As I explained in the essay, I use 3 moving averages, 21, 55 and 89, and I can see from my eye that they would all, the 21 would be above the 55, would be above the 89 in this particular diagram. So one of the questions that we're asked all the time is that this little bit of a pullback, which is normal, is this in fact a pullback, or is it a reversal? And that's quite a difficult question to answer, and that's what I'm going to try and do here. No certainties, just probabilities. So let's look at the first type of trend that Charles Dow spoke about way back in 1880. And this is what's called a fast trend, folks. And it's quite simple. This low, this reaction low, must be noticeably higher than this swing top. So this is called a swing high, that's called a swing low. If this swing low is above that swing top, then this trend is moving fast, and that is what Charles Dow referred to as a fast trend. Couldn't be simpler, really. And breakouts tend to work exceptionally well in fast trends. Okay, so that's the chart is old, I know, but this is a chart, an American health stock. And as you can see, there's a swing low, that's a swing high, and as you can see, there's a little bit of fresh air between the two, and a breakout would have worked. Similarly here, there's a swing low where my cursor is. There's the last swing high, little bit of air in there, and the breakout works beautifully. We've got the same thing happening again. There's a swing low, that's a swing high. If it breaks that is still a fast trend. So that's as simple as it can be. And I have, over the years, had an awful lot of traders who the only thing that they traded, in fact, for 3 to 5 day moves was a breakout of a swing high, which was preceded by, in fact, a fast trend. Okay, simple as that. Now, the next type of trend is that this swing low is in fact exactly at that swing high, and that's what's called a normal trend. And that is what happens in about 60 to 65% of all pullbacks, and it's quite simple. The institutional money invariably will wait for the pullback, and they will bid it at the last swing high. It happens over and over and over again. Richard Wyckoff, a trader that I've got a great deal of respect for, wrote 100 years. He called that a sweet spot. So a pullback to the last old top. The trend is losing a bit of oomph, but it's still a really, really good trend to get into. And personally, I like to buy a pullback to that old high. And this is how it manifests itself. The market will pull back to that level, and then you should get some form of confirmation candle pattern. In this case, I've drawn a hammer, and a buy order above the high of the hammer, stop loss below the low of the hammer, and that's a recipe for a very simple swing trade. And that's something that I've been using for a very long time. The 21 and the 55 invariably coincides with that. So if I were to draw the 21 and the 55, that's the 55, that's the 21, and you'll find that invariably this swing high and the market comes back and kisses that, and this will be in this zone between the 21 and the 55. I call that the zone. Okay, so a very powerful confluence of support, which is the old swing high, and the 21 and the 55. So that's something for you to look out for. Again, that's what happens. There's a swing high, and market will be bidding it here, folks. As simple as that. And the market will, the share price will come to the big bids. And anybody who panics here has no choice but to get out at the bid, and the market will go there. And that's what happened in that example. And here we had, it goes down a little bit lower, and as you can see, there was a tail on that candle, so always difficult to know where the resistance is. Somewhere around there, I suppose. There's a low there as well. So that candle pattern, I think down candles, dojis, and an up candle, that's referred to as a morning star. And I don't have many candle patterns that I use, but hammers and morning stars and outside days are pretty much the three that I use most. That led up to a very decent move. That's a good example of an outside day just there, where this candle, this bar, engulfs the previous 2 or 3 weeks worth of action. We saw one of those in AMD in the US a couple of days ago, and I got out of AMD, and as you probably all know by now, it just kept on going. What can you do? This is a creeping trend, folks, and what happens is that this swing low impinges on the last swing high, and that's a characteristic of the trend slowing down. And when you start to get that, then I don't think you want to be adding to any more positions, and maybe you want to be taking a little bit off. So that's called a creeping trend for obvious reasons. So those are Charles Dow's 3 measures of the trend: a fast trend, air between there and there, a normal trend where it comes back and that resistance becomes support, and then the creeping trend where this comes back and we get that swing low impinges on that swing high. Dow himself didn't use any moving averages or momentum indicators. That's how he classified his trends, and that was written in 1880, folks. Nothing has changed. I think that for me anyway, and this is a belief more than reality, the best way of working out whether we have got a pullback in our hands in the trend or whether it's in fact a change of trend is with volume. Volume doesn't lie. And ladies and gentlemen, if you see the price rising on rising volume and pulling back on falling volume, and it pulls back maybe into that zone between the 21 and the 55, for example, then the probabilities favor this being a pullback. So always have a look, and it's difficult to see, I know. We want to see volume rising on the way up and contracting on the pullback. If the market falls and the volume rises, then that would in fact intimate that we've got a reversal on our hands. So a pullback on falling volume is good news for the bulls. And as you can see, as it went again, volume rose. As it pulled back, volume contracted. That was saying that the probabilities were that that was a pullback and a strong trend, and this was also a pullback and a strong trend. This was first written about by Richard Wyckoff in 1908, and I've shown this to many people in the past. And as you can see, we've got a consolidation here, and this consolidation, of course, is a creeping trend. As you can see, that's impinging on that. When it breaks, it should break on rising volume, and it should pull back on falling volume, as this diagrammatic sketch shows. So a pullback on falling volume, which is preceded by a run up and rising volume, that's a great place to get into a trend. Okay, and I love looking at both price and volume. Not easy, because there's a great deal of noise in the market. People buy and sell shares for all sorts of different reasons, many of which have got nothing to do with the share itself. So as you can see here, we had a couple of pullbacks on falling volume. There's a pullback on falling volume. That's always a good sign that the trend is intact and that you're in a pullback rather than a change in trend. These are old, I know, but they make the point. This is Zoom back in the day, and it rose here on rising volume and it pulls back on relatively low volume. That was saying that this trend is intact. There's the 21, there's the 55, and the 89 would be down below that. This is a trade that I, in fact, got. I was very pleased with this one. As you can see here, the price rose and we get good volume. And then goes sideways in this little triangle. And in the triangle, the volume contracts. And it was just pretty much a sitter that was going to break positively. And it had a great run after that. So, this one I also got, as you can see, price is rising and rising volume. That's great. It's going sideways, pulling back and flat on virtually no volume, breaks out again on rising volume, and then it goes in again to this triangle, folks. As you can see, the relative volume is virtually zero in there, and then it breaks on rising volume. It goes sideways, and then it runs up on rising volume, and I managed to get some of it somewhere around here. Okay, so if you are in a fast trend, then breakouts work exceptionally well. A creeping trend, let it pull back to the last old high, and then look for a candle pattern to confirm you've got a turn. And that pullback should occur on falling volume, folks. This is a normal trend, as you can see. See how that low, in fact, is defined by these tops and that top. So that's a normal trend, but the pullback or the sideways motion, in fact, happened on falling volume. So I hope that helped your understanding. I'll be back on Monday afternoon at 1:30, and I shall show the moving averages in detail. And as I said in the essay, one of our members, Stephen Rush from London, Wimbledon way, has used the 21, 55 and 89, my bow tie methodology, and his portfolio is up 47% this year based on that. So it's hard to beat a little bit of momentum. I hope you find these ideas useful to actually get into a position after the trend has started, and maybe to add to a position.
Yeah.